morning. I'm joined by Andy Brough from Schroder Investment Management. Thanks very much indeed, Andy. So let me start by asking you a very general question where the Gulf of Mexico disaster leaves big oil.
Well, I think people forget how BP got to being so big. Under John Brown, it took advantage of companies like Amarco and all these other big American oil companies that have fallen into financial distress when oil was sort of $10 a barrel, and had made acquisitions very opportunistically and built what was a pretty big company. The trouble with big oil is you have to keep finding bigger and bigger reserves each year to keep growing, and it gets harder and harder. A lot of the easy oil has been found outside of the Middle East, and so you have to go for these deep drilling places. They cost a lot of money, so actually you do need big oil to actually go and find oil for the rest of the world. You can't rely on these small sort of exploration and production companies which are drilling the odd well here and there. As for what happens to BP now, whether it goes the way of all those companies are acquired and gets broken up and bought by someone else remains to be seen. But I personally think there's a lot of value still left in BP, the current share price, and whatever happens, new management are going to come in. We're already seeing them saying, well, actually, the reserve, the 20 billion should be enough, etc., etc. And all the investors are looking for is some form of clarity that a line has been drawn in the sand, right, and we can move forward. But BP will never be the same in the future as it was in the past.
Well, exactly. And how is that going to affect the way investors view the company, or will it affect it much?
Well, no, investors will always look at oil companies and say, right, what is the value of your assets on a 2P basis, i.e. how much proven reserves have you got in the ground, and we'll ascribe a value to that. And if the stock market isn't prepared to actually reward a company with the right valuation, then it'll get taken over. And we've just seen with the likes, the approach by the Koreans for Dana, etc. At the moment, it's a lot cheaper to find oil on the stock market because of the values ascribed to the companies than it is to actually go and drill in the ground.
If we move to other developments today, intervention very much the big theme. We've been talking about Japan's intervention into its currency markets the first time in 6 years, and also mounting speculation that the US will buy bonds, $1 trillion worth, to support its economy. What do you make of all this?
Well, I mean, $1 trillion here, $1 billion there. I mean, sooner or later you're talking real money, aren't you? What the Western world cannot afford is deflation. If you think how indebted consumers are, governments are, the last thing they want is deflation, whereby the value of their debts is going to increase even more. So Bernanke will be sitting there. He's looking at his sort of six-shooter. He's fired 5 bullets. This is possibly the last bullet left. But gold's in an all-time price. People are afraid that if you just turn on the printing presses, where does it all end? Before the First World War, I think the Deutschmark devalued dramatically against the dollar because huge, great printing presses, and people are looking at the American economy now saying, well, if we go down this route, where does it all end up? What is the value of bonds going forward?
Well, so with that in mind, if the Fed does buy more treasuries, how is that going to affect your thinking, your investment strategy, if you like?
Well, let's look long term. So let's go back to sort of 1850 and look in sort of 30-year cycles. Over the last 30 years, bonds, the real return on bonds has been the same as equities. Now, that is virtually unheard of in that whole sort of period. And whenever it's happened twice during that sort of last 160 years, then that has been followed by a bear market in bonds. And this time round, it's hard to see why people are buying bonds if the government's going to be creating $1 trillion of new money. And so real assets, I would argue, are going to be the place to be, and that includes equities and anything with a decent yield.
Andy Brough, Executive Director of Schroder Investment Management. Good to see you again. Thanks very much for coming in.